Morning, everybody. Welcome to another round of coffee and questions. What's today's topic? We do something out of the ordinary. We usually talk about tool reviews and ways of doing things and so forth. But like I tell you in all my videos, I belong to a couple of forums and I have a club locally where we do show tell, all that kind of stuff. The big topic on our last fairly good sized meeting was when you have a side job, a side hustle, what do you do with the extra money? And so, the theme of this is, trying to save and put away some money. Now, let's assume you don't have a side hustle, you just have a job. Okay, well, whether it's a side hustle or a job, what are you doing with the extra money? And most people out there are, I don't want to say they're blowing it, but they're spending it and they're not putting any away. And then they're telling me how a lot of them are living paycheck to paycheck and they're struggling to get their bills paid down, credit card debt, and all these kinds of things. So let me show you this little pyramid real quick. Okay, so let's make things easy. Let's just say you're a W-2 wage earner. So, and I'll do this with like slides along the way, and we'll build on this on what I feel most people should try to do. So what's the first thing that happens when you get your paycheck? Well, first thing is taxes are taken out. Nobody likes that, but it happens and that's automatic. And then after that, what you have is if you're putting away anything into an IRA or a 401k plan. So then, if they're pre-tax dollars or Roth or whatever, then that's taken out. Okay. Then you're left with a certain amount of money, and what happens with that? Then it goes down into your bank account or into your checking account. And a lot of people, after paying all their bills and stuff, and they're buying things here, there, they're getting their Starbucks, they're going out to lunch, they're doing all this stuff, they're broke. And with their credit card debts and all this other stuff. And so a lot of this boils down to, it sounds very simplistic, but a lot of people don't do it. But it's like I was saying, once you get done paying your bills and stuff, you should have a separate account of some kind where you put a little bit of money away each time that you can. And we'll call that an emergency fund. And then the next question was, well, how much do you think we should be putting away into that? I don't know. That's up to you. Now, there's different theories on this. Some people say you should put away at least 3 months of expenses, your utilities, your home, whatever. And other people say no, 8 months. Some people say a year. And so let's just say 3 to 6 months, okay? And you want to build that emergency fund up to that point, slowly as you can. Now, the other thing that you should do, either at the same time or right afterwards, write down on paper what debts do you have in terms of credit cards. And a lot of these people out there, the interest rate on these credit cards is like anywhere from like 19, maybe up to 20, 25, 30%. I don't know, it's huge. And they're just constantly making the minimum payments. Well, that's what the banks and these companies want you to do, is keep charging, keep making the minimum payments, because they'll make a boatload of money off of you in the long run. So your first attempt should be, after you list out all those debts, those credit cards, or those negative debts, we'll call them. It may not be credit cards, it could be credit from a tool truck, it could be, a variety of things, but list them out and say, okay, here's the smallest one, of the balances. And you want to attack that the best you can with all you got and wipe it out. Because let's assume that your interest rate was in the 20%. Once you zero that out and you don't have that anymore, you've just made 20% because you're not giving it away anymore. Now, after you've been doing that a while or along the way, you should have some kind of an online brokerage account, let's say, because you want to. but you open up this trading account, which is free to open up on a lot of platforms. It's free. Then at the end of the month or the end of 2 weeks or stuff, you say, hey, I'm going to throw 40 bucks in there, 50 bucks in there, 100, whatever you can. And you're going to let that build up, start building up. And then you're going to start thinking about, what should I invest it in? Okay, well, there's lots of opinions on this stuff. Like, you've got basically 3 types of funds if you don't want to buy individual stocks. And if you think that's a little too time consuming and you don't want to study, figure out fundamentals and technicals and all this stuff, if you don't want to do that, you can pick an index fund, a mutual fund, or ETF. Now, index funds are passively managed. They're computer run, okay? Mutual funds actually have a fund manager. So they're going to be a little bit more expensive. You need to take a look at the expense ratios on any one of these that you pick. And then the ETFs, they kind of mirror almost an index fund. And those are real low cost, low expense ratio investments. Now, the index, the mutuals, and the ETFs are like a basket of companies. They could have 20 in there, they could have 200. And it's a basket of companies, so your risk is spread out. If one company fails, well, the other ones are still doing okay, so you don't have that much volatility as though you invested in just one single company and something went bad. And you don't have to watch them all the time. You can set it and forget it, as long as you've chosen a decent one to begin with. Mutual funds are okay. Most of them, they don't make money, and those fund managers, they're going to get paid either way, no matter what. The ETFs and the index funds, you still get that charge, but it's very low compared to most, well-managed mutual funds. So you take a look at the ETFs, and then you can figure out what you want to do. You can have it very broad, like saying, you got some McDonald's, you got some Home Depot, there's some Delta Airlines. They're all in this one particular ETF, but there are many, many ETFs and many, many, index and mutual funds. So you could take a look and say, well, I think the trend is, and I'm not telling you to do this, don't believe anybody that tells you what to buy on YouTube. I'm just giving you very broad idea and selections. But let's say that you liked electric vehicles. You could do a Google search for ETFs that invest in electric vehicles. And so you take a look, and so they've got, multiple companies in there, maybe 10, 20 that are doing batteries, or they're doing cars, or whatever. It could be Ford, GM, Tesla. Then you got the lithium battery companies, and all of these are individual companies and stocks within that ETF. Okay, and then you can buy a share or shares of that ETF and begin to put away money that way. The idea here is that you start to invest, and you want to build up something that is going to be worth more, hopefully, in the long run. The one thing about the market, it goes up, it goes down, goes up, goes down. You have to have the stomach to ride out this roller coaster ride, and know that in the long run you've made a good solid investment. It'll go up over time. And when it sinks down, maybe you want to buy a little bit more. It's like a Walmart sale. It's like, oh look, it's on sale, and you want to buy a little more. Then you wait for it to come back up. There's lots of different basic philosophies on this stuff. What I'm saying and what I do is, we sat around out at the club, we discussed all of this. I'm in it for the long game, okay? I used to do day trading, and I used to do swing trading, and I've done these things, okay? But I'm on top of retirement, more or less. I work, just a little bit, part-time, like I tell you in my videos, and the rest of the time I got my side hustles and everything else. And so that's where my money goes. But I'm in it for the long term, the long game. So I want to know every quarter that it's producing something in terms of, let's say, dividends. And then I keep reinvesting those dividends back into that same fund. But I also have stocks as well as, these funds. It's kind of, I have it spread out. I would encourage you to kind of do the same. Now, what's the next step? Let's say that you are thinking, I want to just do some of both. Okay, fine. Somebody says too hard to do, and I go, Well, let's break it down to the most basic of basics for a second. And let's forget about the technicals and the fundamentals and can you read an income statement and all of that. You'll learn that over time, depending on how much you want to get into this. But let's take a look at this extreme basics. I told them sitting across the table, in where we meet, I go, if I asked you, what company do you believe will still be around in 5 years? What would you tell me? And the guys, we're all sitting around, and one of them blurts out Starbucks, another one blurts out Microsoft, Apple, Coca-Cola, Procter & Gamble, Johnson & Johnson, Tesla, and everybody is saying they have a firm belief these companies aren't going anywhere. They're going to be around for 5 years. I said, what about 10? And they all said almost the same companies, almost exactly the same companies. They're still going to be here in 10 years, and they're still going to be doing well. Okay, so you've taken that first step in what do you believe in that is a good, solid company. Next, do they have a good, solid CEO? Okay, so you need to determine that, and you can read about it and figure that out. Third thing, is it a good product? I mean, you should know that yourself. You can look around at iPhones or the people that are drinking Starbucks or the people that drink Coca-Cola or everybody that's going to McDonald's, and so forth, and say, yeah, they got a good product. Now, if you want to dig deeper, every company that's on the stock exchange has to file what they call a 10Q and a 10K. Now, the 10Q are quarterly earnings, it'll show you, and the 10K are annual. It's that simple. You can call it up and you can take a look, and it shows you in columns, and it gives you an idea on how these companies are doing financially. And there's plenty of videos and information out there to teach you how to read them. It's not complicated. So I wrote on a piece of paper here, because somebody goes, well, you say investing in the funds is passive, where I can just invest and I don't have to watch it all the time. I can just kind of add to it and let them run. Yeah, that's true. So we'll give us some examples. Okay, so I'll give you a few examples, but I'm not telling you to invest in them, but it'll give you an idea. I wrote them down. One of them is VTI, it's a Vanguard fund. And that's the total market itself, everything. Then there's the DIA, that's the Dow Jones Industrial Average, and you can read about that. That focuses in on that group. Then there's the SPY, that's the S&P 500, SPY. Then there's the QQQ, that is NASDAQ. So you see each one of these, you can invest in different sectors too. Total market, or you can break it down, like I said, into, the Dow, the NASDAQ, what have you. And I've given you those symbols as a starting point. There's SPYD. Well, that's the S&P 500, but they focus in on the companies that are paying dividends. And then, like I said, each quarter dividends are paid. I have them reinvested back into those funds. You don't have to. You could take it as cash and invest it somewhere else. But if you want to set it and forget it, that's the way to do it, because when you originally set it up, it'll ask you, do you want the dividends reinvested? Yes. And I just let it keep compounding. It's like a snowball going downhill. It'll get bigger, 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 hopefully over time. You just have to be selective on what you're investing in. And if you don't like that, you can do more research and you can find sectors that are only in technology, or they're only in medical, or they're only in oil and gas, or they're only in electric vehicles, consumer goods, on and on and on. And you can say, well, this is the way I think things are going to go, and so I'll find a fund that focuses in on those sectors. You can do that through your research, or you can stay broad, like I was explaining to you just a little bit ago in the beginning. Or you can do nothing at all. You can keep living paycheck to paycheck and do nothing about it. But a dead bird under the nest never learns to fly, does it? Okay, so of these 15 or 18 of us, and we were all batting this around, I said, here's a challenge. I said, let's do a challenge. Okay, this is what I'm saying. Let's say nobody will do it for a month, I know. I go, but let's say that you on paper will track your expenses every day for the next 2 to 3 weeks. Let's say 3 weeks. I'd like to go a month, but I gave it 3 weeks. So how many of you are willing to do that and put away $5 a day? $5 a day, and then every week you'll take that $5 and you'll put it into that brokerage account fund. So there were 5 of them that said they'd do it. The others thought the challenge was silly and too ridiculous. They go, okay, well, none of you are doing anything right now, so I don't think it's silly and ridiculous, and it's a starting point, and it's also a little bit of a learning thing. You'll see where your money's going by tracking it. And question yourself. Each day you go out, it's not like, oh, I have to go spend some money. I have to have my $10, $12 Starbucks, or I have to have food delivered to me at work and pay the driver, and I see people do all this stuff. And to me, it's like ridiculous. It doesn't matter how much money you have. I mean, you're just kind of like throwing it here and there and wherever. And so it's like, track your expenses, ask yourself each day for 3 weeks, is this something I have to have, or I need to have it? Or is it just something I'd like to, or it sounds cool and fun? Stay within this and don't spend and don't buy what you don't need for 3 weeks. For 3 weeks. And then do what I'm saying, okay? Put the $5 away, and every week we'll shoot for on Mondays, let's say. Monday, Tuesday, right in there. You're going to take that $5 a day you put away, that's $35 a week, and put it into that brokerage account. Then we're going to take that $35, and we're going to put it half into one of these funds. We'll pick it out together. And the other half, pick a stock that you believe in. It doesn't matter what it is. I'll track it here on Yahoo Finance. Just do it for 3 weeks. Then let's reevaluate at the end of the 3 weeks, and then you can still tell me that that was a foolish thing to do, or it was silly, or whatever negative comment you want to make. Or you can begin to see that it is possible to start putting away money for that emergency fund or just for investing. Okay, I'm sure this is getting long, okay? I'm the Home Handyman. I hope you click subscribe. If you like this and you want to keep following me and you want me to do a part 2 to this, let me know in the comments below. If you want to jump in on this $5 a day thing, let me know that too. And we will all keep track of it together. Together, you'll start to put away money and make money. I know it works. I've done it before. See you on the next video, man. You folks have a great day, and I'll see you again soon. Bye-bye.